السلام عليكم ورحمة الله تعالى وبركاته في حلقة جديدة من برنامج سؤال للخبير الذي يقدمه مركز الجالية العربية كل أسبوعين بأربعاء على الساعة 3. في كل حلقة سنستضيف خبيرا في ميدان معين لإعطاء المعلومات للجالية العربية سواء كانت داخل كندا أو خارج كندا للتعرف على موضوع في مكان مخصص. فاليوم الحلقة مخصصة لشراء أول بيت في كندا. Buying your first home. بطبيعة الحال هناك أشياء مالية وقانونية دقيقة يجب على كل شخص ينوي إن شاء الله شراء بيت في كندا معرفة تبعها. وفي هذا المجال سنستقبل اليوم ضيفين كبيرين وعزيزين إلى قلبنا، الأستاذ كيرولوس حنا وهو مستشار استثماري ببنك CIBC، وكذلك المحامية اللطيفة مارلين دوس بطبيعة الحال التي ستقدم بعض المعلومات القانونية الدقيقة في هذا الميدان. بطبيعة الحال كما نقول أسئلتكم مرحبا بها كالعادة. ننتظر أسئلتكم للإجابة عليها قبل أن نمر إن شاء الله إلى تقديم اليد أو الملف لضيوفنا الكرام. Bonjour tout le monde. Aujourd'hui, nous allons donc présenter la deuxième épisode, comme d'habitude, de une question pour l'expert. Nos experts aujourd'hui, ce sont Madame Marlène Doss, c'est une avocate spécialisée dans l'immobilier, et également notre cher ami et confrère, le consultant d'investissement qui travaille à la banque CIBC, Kirolos Hanna. Aujourd'hui, ils vont parler de ce qu'on appelle acheter votre première maison. Tout ce qui est finance et loi concernant l'achat de votre première maison. Donc, je vais laisser les deux frères présenter notre frère et notre sœur, de présenter leur domaine. Kirolos Hanna Habibi, لك الخط.
My name is Kirolos Hanna. I'm the mobile investment consultant for CIBC in the Thornhill community and other parts of the Greater Toronto area. Today, we're actually going to be talking a little bit about how to purchase your first home, and for someone who is thinking about purchasing your first home, how that can become achievable. So I'm just going to share my presentation here. Now, can you see that? Mustafa, can you see my screen?
Yes, I can.
Perfect. So as I was saying, we're talking about thinking of buying your first home. There's nothing quite like owning your first home. We need to learn how you can make it a financial reality, though. There's a couple of basics that we're going to talk about, which is determining whether you are financially ready to purchase a home. We also want to know how much you can afford and put a savings plan in place. And finally, we also want to take advantage of government incentives and resources available for first-time home buyers. Some of the things we're going to be getting into today we're going to learn what to expect when you start looking for a home, understanding the mortgage types, common terms, additional costs, and payment options. And finally, we want you to be ready for the next steps in your home buying journey. So we'll start off with knowing the basics. We want to understand your financial picture. So factors you should consider to determine your readiness to buy. The first thing would be income and affordability. So we want to understand what your income is. This would be gross, so before any taxes are calculated. And then we want to look at your employment history. So how long have you worked for the company, or how long have you been in the current industry that you're in? The third thing we're going to talk about is debt. So how much you owe. So if you have line of credits, if you have visas, if you have car loans, any other mortgages. We need to understand your debt situation as well, which also ties into the fourth thing, which is credit history. What we want to do is also understand your credit history. Do you have a good credit history, or do you have a history of late payments? So this is something and a very important part of the financial picture to qualifying for your first home. We also want to look at savings. So how much do you have saved up for a down payment? We want to look at any history of savings. So have you been saving up over consistently over a period of years, or has the majority of the deposit been gifted from a family, from one of your family? And then the last thing we're going to talk about is life events. So we want to talk a little bit about mortgage insurance, just to make sure that you and your family are covered in case of any unforeseen situations that may arise in the future. So, are you financially ready? We want to determine what you can afford. So we can help you determine which price range you can comfortably afford and how this may impact your cash flow or savings goals. So some things we want to consider is annual household income. So if it's you or you and a spouse that's going to be on the application, we want to see what your annual household income is going to be. Again, this is before taxes. So we use the full amount. So if your salary is $75,000, then we will use the full $75,000, not what you get paid after taxes. The other thing we want to look at is amortization period. So how long the life of the mortgage is actually going to be. So generally, when clients get their first mortgage, it's around 25 to 30 years. And if we're able to extend it to the 30-year period, then generally you may qualify for a little bit more of a mortgage. However, you have to be able to qualify for the 30-year amortization, which we will get into later on in the presentation. The next thing is talking about a little bit about down payments. So we want to know how much down payment you have, because that'll make a big difference in how much you can actually afford. There are some government incentives that, again, we're going to be talking about a little bit later. But depending on the type of down payment you have, you can qualify for a much larger mortgage than if you have less than 20% down. The next thing we're going to talk about is closing costs. So there are some closing costs associated with purchasing a home, such as lawyer fees, land transfer tax, and some other smaller fees like moving and maybe property valuation and inspection as well. But these fees are also associated with purchasing a home. And the last thing is property taxes, home insurance, and other additional expenses. So property taxes is another factor that can determine your affordability in purchasing a home. Now, saving for your home purchase. So how can I actually start saving for my home? Some considerations we want to look at is, when do you plan on buying, and how much will you need to save? So depending on when I plan on buying will really affect the type of investment I'm looking to do to start saving for my home. So for example, if I'm looking to purchase 5 or 10 years out, there are different investment options that we can use to help you potentially maximize your returns, and help you save more for your down payment. And then we also want to look at how much will you need to save. So if you're looking at you need to save $100,000 in the next 10 years, we need to understand how we're going to get you there, right? We need to make sure that it's actually feasible, so we're able to save that much every year, $10,000 a year for the next 10 years, or what type of investment will help complement the plan to help you reach to the $10,000 a year or the $100,000 after the 10 years. So there are a few different options that we can look at, which are ways that we can save for your down payment. So we have short-term savings and investments. So generally for clients who are looking to purchase, I would say within the next 3 months to a year or 2 years out. We have regular investment plans. Regular investment plans help us withdraw a preset amount, a dollar amount from the client's account every on a periodic timetable. So, for example, every week, bi-weekly, semi-monthly, or monthly, we can set out to withdraw $100 every time, and then that'll equate to a larger amount over the year, and also with the compounded interest of the different type of investment that we're looking to invest in. We also have tax-free savings accounts, which are a good option for clients to start saving for their first home as well. Any growth in that account is completely tax-free. So if I invest $5,000 and it grows to $10,000 in a year or 2 or 3, that I don't have to pay any taxes on that growth. We also want to look at registered retirement savings plans, Rrsps. This is a great way to save for your first-time home buyer. If you are in a higher tax bracket, so generally what will happen is, and we'll talk about this, I believe, in the next couple of slides, is you're actually able to withdraw from the RRSP tax-free up to $35,000 to use for your first-time home buyers. And that's actually the home buyer's plan on the next point there as well. Now, some incentives for first-time home buyers come from the government of Canada. So some options are the first-time home buyer's plan, which is, again, as we discussed, withdrawing up to $35,000 per applicant for your first-time purchase. We have a first-time home buyer's tax credit. So this is you get a certain portion of the land transfer tax back for being a first-time home buyer. And then we have the first-time home buyer incentive. So this is if you have less than 20% down, there are some programs available to you to help you be able to afford the home that you're looking to buy. The home buyer's plan helps Canadians become first-time home buyers. Under the plan, if you qualify as a first-time home buyer, you can withdraw up to $35,000 tax-free from your RRSP to buy or build a home. Now, to avoid tax consequences, you have to pay back the amount withdrawn to the RSP over a 15-year period. So you have 15 years to be able to pay back this $35,000 into your RSP tax-free. Now, this is for joint buyers. They can also access $35,000 from their RSPs, totaling a total of $70,000. Okay. Now, what we want to do is create a plan. Do you have a savings plan in place? And is it difficult for you to keep your cash flow focused on savings? We can help you with a regular investment plan. As discussed before, we can save weekly, bi-weekly, monthly, semi-monthly, and we can actually start doing that with your paychecks as well. Invest in products that can provide you growth and have the flexibility to access funds when you need them. So depending on the type of investment, so if we look at a tax-free savings account or non-registered, you can access these funds at any time. RRSPs are a little bit more tricky because they're if you're withdrawing it for any other reason than first-time home buyer, then you will be taxed upfront. And now the graph on the right will actually show us the growth of $250 weekly over a 10-year period on a 5% return. So if we look at a monthly contribution of $250 over a 10-year period, we would have our initial investment would be $30,000. If we were to put it in an investment with a 5% return, you'd be looking at $8,748 growth. So the money would grow to $38,748. Now, if we're able to afford to do $250 bi-weekly, so every 2 weeks, our initial investment would be $65,000. That would actually grow to $83,862. And then on the far right, you have a weekly contribution of $250, so roughly $1,000 a month. That would look at $130,000 over a 10-year period of our initial investment. That investment at a 5% return, you'd actually be looking at roughly $167,646 at the end of that 10-year period. So these are different, I would say, different periods of saving. So we have monthly, biweekly, and weekly frequency, of saving. And depending on what you can afford, we can look at building a customized plan for you. Now, when you're ready to buy your home, what information is required to qualify for a mortgage? So we went over this briefly in the beginning. First thing we want to look at is gross annual income. So of the applicants, we want to look at employment history. So again, how long you've been with the company or how long you've been in the industry. You want to look at credit history. It's very important that your credit is you have good credit. There are minimum credit score qualification metrics that we use to qualify clients for mortgages. And then the last thing is a debt to income ratio. So this is your assets versus your liabilities. Now there's a certain ratio that we can't exceed to be able to qualify you for the mortgage you're looking for. Some important financial terminology. So when you hear the word term, the term of your mortgage represents the length of your contract with the lender and is only a portion of the overall amortization period. You decide how long you would like to borrow from a lender. So, for example, if I go to apply for a mortgage, I can select many different lengths of term. So I can do from as low as a 1-year term to, I believe, some lenders have up to 10-year terms. The most common I see in my experience are around 3 to 5 year terms. Now, this is not how long the life of the mortgage is. This is how long you are pretty much committing to the lender for, and how long your rate is locked in for. Now, when we talk about mortgage principal, it's the amount of money you borrow to buy your property. So, for example, if I'm purchasing a property for $500,000 and I put $100,000 down as a down payment, which is 20%, my mortgage principal is $400,000, just the amount that I'm borrowing. And then we're going to talk a little bit about interest as well, which is the amount the mortgage lender charges for lending you the money. So all different banks, different brokerages have different rates, and they're tied to the term and the amortization. The amortization is the length of time it would take to pay off the entire mortgage in full. So this is different from the term, and a lot of clients get confused between term and amortization. So the amortization is the life of the mortgage. If the interest rate remained constant and payments were made strictly as scheduled, you work with your lender to determine an amortization that fits with your financial goals and situations. Now, understanding your mortgage options. So it's helpful to familiarize yourself with some of the terms and options available so that you can select the financial solution that's right for you. So we have different terms when we look at fixed, variable, closed, and open. Okay. So when we look at fixed, what fixed is, it's a mortgage with an interest rate that is fixed and does not change. So these are clients who are committing to a certain interest rate for a certain period of time, and it's fixed and it's closed. So you won't be like you can break the term. However, there will be associated penalties. But the important thing is that the rate is fixed. It will not change for that term. And then we have variable. It's a mortgage with an interest rate that fluctuates based on the CIBC prime rate. So CIBC has a prime rate which is currently 2.45, and that's the variable rate is based off of the prime rate. So it's either a plus or a minus of the prime rate, and this rate could fluctuate over the term of your mortgage. So if you select a 3-year variable, you're not locking into a specific rate, you're locking into a specific discount of the prime rate, okay? And then there's closed term as well. So that's a mortgage with limited prepayment privileges that incur prepayment charges if prepaid by more than the contracted amount. So usually when you lock into a closed mortgage, you are allowed to pay down the mortgage up to a certain percentage every year of the principal amount. So for example, if I'm borrowing $500,000 as my principal mortgage, and I usually it's around 20% that 10% that I'm able to pay down. So I can pay down 50,000 every year for the term of my mortgage. And then once the mortgage is up, I can either renew it with my current financial institution, look to transfer the mortgage out, or pay it in full if you can do that as well. And then we have open term. That's a mortgage that can be repaid by up to 100% of the balance at any time without any prepayment charges. We don't see this too often, but these are for clients, I would say, that maybe their mortgage is coming up for renewal and they decide to go into an open term because they're either looking to sell their house and pay off their mortgage, they're going to be mortgage free, or they're just not 100% sure of which lender they want to commit to yet, and they just want that flexibility for a short period of time. Now, we have different types of mortgage down payment options. We have a high ratio mortgage, which is insured. So those are down payments or equity, which is less than 20% of the property value. So if I don't have at least 20% of the property value, I am considered applying for a high ratio mortgage, or an insured mortgage as we call it. So the rate used to qualify borrowers in the Bank of Canada mortgage qualifying rate is it's in effect at the time of the mortgage application. So this is the fairly new qualification metric, which is widely known as the stress test. And then we have a conventional mortgage. Conventional mortgages are for down payment or equity, which is at least 20% of the property value. So if I'm putting 20% down or more, you're considered a conventional mortgage. So you will not have to pay any insurance costs, and you will still, but there are still qualifying metrics, which is the also qualify under the stress test, same as above. Now, we want to look at budgeting for additional costs because, as we talked about earlier, there are additional costs associated with purchasing a home. It's important to have savings set aside for some of the additional costs associated with buying a home. Some of these costs include home inspection fees, home appraisal or property valuation fees, legal fees, realtor fees, sales tax, land transfer tax, any moving fees, and any additional closing costs that may come up as well. Now, we want to talk a little bit about protecting your family from the unexpected. Now, when you invest in the right insurance coverage, you can help protect your home and ensure the lifestyle you and your family enjoy today. Types of insurance are title insurance. You also have mortgage default insurance. So this is for financial institutions cannot lend more than 80% of the value of the property without mortgage default insurance. So if I'm putting less than 20% down, then I am applying for an insured mortgage. I will have to pay what we call insurance premium, and there will be, it's called mortgage default insurance essentially is what we're getting, is what we're paying for. Then we have property insurance as well, which is collected by the lawyer at the time of closing. And then we have CIBC mortgage creditor insurance. So this insurance covers disability, life, or critical illness. In case something were to happen to you, or whoever is covered, like you are the joint applicant, we want to make sure that you and your family are protected and are able to continue paying your mortgage so that it doesn't go into default status. Now, we're just going to review here everything that we talked about and simplify the process for you. This is pretty much a roadmap of understanding your mortgage journey. We're going to begin your home buying journey by first assessing your finances, building your home buying team, preparing for your meeting, and determining what you can qualify for. Second thing we're going to do is start the search for your dream home. We're going to discuss affordability options with your advisor, work with your realtor, and place an offer on a property. The next step is to secure a mortgage approval for the property. Once you have an offer or an agreement, you will give that agreement to your advisor, and we will finalize and submit your mortgage application. We'll do a property appraisal and get you a final approval. Once that's all done, the final stage is just getting ready for closing, which is handing everything off to your lawyer and closing on your home. Effectively. Some additional resources we have here is you can go to CIBC.com and look at our current mortgage offers. You can also look at mortgage calculators. This will help you see how much you can qualify for. Now, this is not a pre-approval or an approval, so it's very important if you're looking for something a bit more concrete to reach out to an advisor. And then there's a little bit of articles and some advice as well there that talk about just some advice on home ownership as well. And at the bottom, there are some external links for the home buyer's plan, home buyer's tax credit, and first-time home buyer's incentive from the CMHC and the CRA. Reviewing your goals after home ownership. So determine how owning a home has changed your cash flow and savings or retirement goals. So we can help you reevaluate your financial plan so you and your family's needs and goals are met. So considerations include saving emergency funds for home-related contingencies. So for example, if something were to happen to your home, like a leaky roof or like something with plumbing issues, you have an emergency fund that you can use for that. Also saving for your short or long-term goals, and paying back your home buyer's plan if you intend on using your Rrsp first-time home buyer's plan for the down payment of your home. The next step, so it's let's talk about your unique situation. Set up a one-on-one meeting to help you achieve your home buying goals. Together, we can help you make your dream of home ownership a financial reality. If you have any additional questions, you can feel free to contact me. That's my contact information there. Again, my name is Kirolos Hanna. I'm the mobile investment consultant here in CIBC for the Thornhill community. It's my phone number and email address. Feel free to reach out to me at any time. Thank you.
شكرا جدا على هذه التفسيرات الموسعة والواضحة جدا. بطبيعة الحال في أخي بيطلب ترجمة بالعربي، مع الأسف الشديد الوقت ضيق لأنه أمامنا كذلك المحامية الأستاذة مارلين دوت التي ستقوم بإعطائنا بعض المعلومات، وبعد ذلك سنعود للرد على بعض الأسئلة تبعكم أو ترجمة أو تقديم ملخص على ما قاله الأخ كيرولوس في المحاضرة تبعه. إليك الخط الأستاذة مارلين.
Hello, everyone. Thank you for having me. Okay, let me share my screen as well with you. Did that work? Oh.
Yes.
Okay, great. Okay, so I'm going to be filling in some of the information. Kirolos talked about several things that are relate to being a first-time home buyer, and I'm going to take you from the legal perspective and share some other information with you. So the first thing we think that you need to do is consider what kind of property you want to buy and why. So what's the purpose of your purchases? Is it an investment property? Is it somewhere that you want to live in? Is it, for some business? You have to figure out what the property is for. And then you also need to decide on the location. You need to decide if you want it to be a freehold or a condo. So whether it's part of a condominium in a building, and I'll explain some of those details afterwards. Or if you want it to be a standalone house, and what kind of house. And of course, you have to consider what you can afford, as Kirolos had gone through with you guys in some great detail. And as he mentioned, there's two different processes. So when you contact a mortgage advisor, such as Kirolos or a bank or a private lender or whoever it is, the first stage with the banks, and usually a lot of, they call them A lenders, is to get a pre-approval from them. So they'll go through all the documents that Kirolos was mentioning with you, and they'll say, okay, we can estimate that you are pre-approved for this amount, and now you can go shop for your house. So they're saying we'll give you, based on the information that you've given us and accurate appraisals of the property, etc., we will give you a mortgage of X amount. However, there's a difference between the pre-approval and the final mortgage commitment, which is what we are given later on. So after you've entered into an agreement to purchase the property, then you would go back to the lender and you would say, okay, here's the agreement of purchase and sale. This is what we want to purchase, and this is what we're expecting. Can you confirm that this is the mortgage that we're going to get approved? Usually there's a little bit of a window that's included in the agreement of purchase and sale for somebody who's using mortgage funds to make sure that they can actually afford it and that they're actually approved. And if they are not going to be approved for the amount that they will need to close on this property, then it gives them, they have that little window where they can get out of the mortgage. Get out of the purchase agreement. Okay, so what is the agreement of purchase and sale? The agreement of purchase and sale is actually the contract. So it's often drafted by the mortgage agents, and they will work with you to make sure all the terms that you want in the agreement of purchase and sale are in there. It includes things like details of what it is exactly that you're buying. So if it's a house, then the detailed description of the house. If it's a condominium, are you buying just the unit? Are you also getting a locker? Are you getting a parking space? And they make sure that it's all in there. It includes how much you're going to be buying the property for, and what you are going to be paying for the deposit. So purchase price of this amount, you're putting down presumably the 20%, ideally, or whatever it is. And so from that, the lawyers and us when we get involved in it, can determine what you will owe when you come to close on this property. The agreement of purchase and sale also sets down the closing date. So you enter into this agreement, and then we say, okay, you're actually going to get possession of the property on this date, which can be a month away, can be 2 months, 3 months, depending on what the two parties negotiate and agree to. And it also says any conditions that you have to satisfy, whether you're the seller or you're the purchaser, before the deal is going to close. Okay, so if you're buying a condominium, there's something that's provided called a status certificate. And the status certificate is something that is usually reviewed by the lawyers. So it's included, one of the conditions in that agreement would be that if you're buying a condo, that the seller provides you with a recent status certificate. And it's important to look at this document because the status certificate tells you a few things that are important about a condominium. When you're buying a condominium versus buying a house, you're buying your unit, so you're buying the apartment or the place that you're actually going to live in, but it's almost like you're buying a share in some common parts of that building, right? They call them the common elements. So you're almost investing in the whole corporation. So this status certificate is going to tell you about the health of the corporation. It's going to tell you what good standing it's in. It's going to tell you if anybody has sued the condominium corporation, if there's anything outstanding. So it's important for your lawyers to be able to review it. And it's important that if you are buying a condominium, that there is some condition in there that allows you to back out of the agreement on the basis that the status certificate doesn't satisfy you for whatever reason. Okay. Now there's a difference in the agreements of purchase and sale if you are buying a new home versus you're buying something that somebody already owns. When you're buying a new home, the agreement of purchase and sale actually looks quite different, and it's quite a lengthy document. It includes a lot of things that the builders will include, so things that they will charge at the end, okay, that they will adjust for when you close. So they're added costs. And we tell our clients usually they're often about $5,000 to $10,000 in addition to what you were agreeing to in the purchase price of this new build home. Also, when you're buying a new build home, generally HST has to be paid on top of the purchase price. Okay, there are exemptions for a new home by first-time new home buyers that plan to live in that property. So again, it becomes important whether it's an investment property or whether it's somewhere that you're going to be living in, because you can be entitled to a portion of that HSC, the taxes, being returned to you or even not charged to you on the closing. So they can be adjusted for. And also another difference between a new home and buying a property that somebody already owns is that there are two different closing dates almost. So when you're buying a new build condominium, for instance, there's what's called an occupancy date. And then there's the actual closing date where you actually get the title to the property. So on the occupancy date is where the builders say, okay, the place is substantially completed. It's almost finished and you can move into it, but we're not ready to give you title to the property, either because they still need to get some permits or whatever it is that they need to do on their end before they can actually register it into your name. However, so once you move in, it's almost like you are renting the place that you're going to own. You have to pay a monthly amount. You become responsible for the taxes, the property taxes on your unit or your property from the time that you take occupancy of it. Okay, and you're responsible for all the utilities. So heat, hydro, electricity, maintaining the property, it all becomes your responsibility. But the builder is still entitled to the property until the final closing date, and they will tell you when that date will come. Okay, and Kirolos already mentioned some of the closing costs. I think one of the big ones that people are not aware of is the land transfer taxes. So those are the taxes that are paid just for anybody who purchases a property, and they vary according to the value of the property and the location that you're purchasing it in. So if you're purchasing a property in Ontario, in the Greater Toronto area, there are additional taxes than when you purchase it outside of the GTA, we call it. So these are things that you need to be aware of. Again, they're based on the amount of the purchase price of these properties, and they are paid when you come to close on the property. So sometimes people are not aware of these additional prices, and they should be aware of them. So when you are ready to close, so now you've signed the agreement of purchase and sale, and you are ready to close on the property. So what do you need to do? You need to make some arrangements for closing on the property. So you would need to book the movers, right? You need to book an elevator if it's a condominium, and you need to schedule the time that you can get in. You would finalize the mortgage. Well, the lawyers actually do that. But we would prepare the documents that you would need to sign in order to prepare for the closing. You would have to set up your own home insurance. So there's a difference. There's a couple of insurances that are needed for a closing. One is called the title insurance, and the other one is the actual home insurance. The title insurance is ordered by the lawyers on your behalf, and it protects you in case there's any issues related to the property specific to the title to the property. But the homeowner's insurance is what protects you, what's in the house. So what you own and what you bring into the house in case something happens, a flood, a fire, things like that. And also, just so you are aware, usually the mortgagees, so the lenders require you to have home insurance and require you to have title insurance, and they will specify what they want in both of those policies before they will agree to give you the money when we come to close. Okay, and the last thing that you need to do when you're preparing for your purchase and for moving in is you actually call the companies. So you call the utility companies and you say, I'm moving into this house on such and such a date. I need to set up my phone, my phone line. I need to set up my electricity, my hydro, water, all of those things. And then they set it up so that it starts on the day that we actually close. So just giving you an overview of how the actual closing process looks, okay, from the beginning to the end. So after you've signed that agreement with your mortgage agent and you are ready to move ahead with the next steps, what happens is you get in touch with your lawyer, and your lawyer will ask for a copy of the agreement of purchase and sale and a few other things. And then for the purchasers, it is our responsibility to do some searches related to the property to make sure that you are getting it's called basically clean title, so no issues coming with the property. If we notice that there are any issues, for instance, often this is the case, if you're buying a property that somebody else owns, there's usually a mortgage that's already on the property. So then we write to the lawyers of the seller and we say, this is the mortgage that's on the property, or these are the other issues that we're seeing here. Make sure that these are corrected before we close. And then the lawyers on the other side have to agree to do these things and commit to it before you are going to take ownership, because you don't want to take somebody else's issue. Okay, then when you're buying, you also let your mortgage agent or whoever it is know that we are your lawyers, if it is us or whoever your lawyers are, who's representing you in relationship to the actual closing. And then the lender gives us the documents that they need for us to prepare, and they give us instructions of how we're going to set up this mortgage. And then on the closing date, once we're in communication with the mortgagors, and then on the closing date, they give us the mortgage funds so that we can send them to the sellers. So in addition to getting their documents and preparing those things, we also look at everything else. So we look at, what was the purchase price? What have you already paid? Are there any adjustments that need to be made to the sellers? So how much property taxes have they paid? How much should they have paid? Who needs to get a credit? We include all these things, and then we would get in contact with the clients and say, okay, this is what we have. This is what you paid as your down payment. This is what you owe on closing, including the land transfer taxes, the legal fees, etc. So we need X amount from you. And this is what they call the closing costs. So they vary because it obviously depends on the amount of mortgage that you're getting. It depends on what you've already paid as a down payment, and it depends on land transfer taxes, which is different for everybody. So we do those calculations and we let the clients know so that they can prepare. Then we meet with the clients, we review the documents, they sign what they need to sign. They give us those funds that we will need, and we put it into a trust account. So we hold it onto it until the closing date. And then on the closing date, we exchange things with the lawyers on the other side. So we will give them our documents, we will give them the money, we will give them what you need to get the transaction closed. And the seller's lawyer will give us their documents, and they will give us a set of keys to the house. And they'll give us confirmation that what they need to do has been done or will be done right after we close, okay? And then if everything is good and both lawyers on both sides are satisfied with everything that they've received for their clients, then we agree to close and we actually register the deed and the person becomes a homeowner. And then we get in touch with the clients and we say, congratulations, please come and get your keys from us. Now, the thing that people don't realize is we don't know what time that's going to happen, because sometimes we don't have control over when the lenders give us the funds. Sometimes things come up at the end. So what a lot of lawyers tell their clients, and we do too, I mean, we aim as to have it closed as early as possible. But if you're arranging for moving and stuff, people often don't arrange for the movers to begin or to get ready to go into the property until closer to 5 o'clock, which is the latest time that we can actually register a closing. So thank you for having me here. This is my contact information. If you guys have any questions or if you need any help with anything, please feel free to get in touch with us. And it was a pleasure being here.
شكرا جزيلا لكل من الأستاذة مارلين على هذا التفسير الواضح والموسع على المسائل القانونية فيما يخص شراء البيت لأول مرة. مع الأسف نعتذر لمتتبعينا نظرا لضيق الوقت فلم نستطع أن نقدم الترجمة الضرورية لما دار في هذه المحاضرة اليوم. نشكر كذلك جزيل الشكر للأستاذ كيرولوس حنا على التوضيحات الموسعة التي قدمها فيما يخص التوضيحات المالية، وكذلك الأستاذة مارلين على التوضيحات الموسعة التي قدمتها في المسائل القانونية لشراء البيت لأول مرة. nous remercierons vraiment les deux experts que nous avons donc présentés aujourd'hui, Kirolos, Hanna, l'investisseur, le consultant d'investissement au sein du CIBC, et Madame Marlène, notre avocat, qui nous a donc parlé sur l'importance d'acheter la première maison au Canada et les méthodes d'achat ou les méthodes à suivre au niveau financier et au niveau de la loi. Donc في ختام هذه الحلقة نشكر كل من كيرولوس حنا على المجهودات الجبارة التي قام بها في تقديم هذا الحلقة والمحاضرة، وكذلك شكرنا موسع وموجه كذلك للأستاذة المحامية مارلين دوس على مشاركتهما الفعالة والقيمة في هذه الحلقة. شكرنا كذلك يذهب لمخرجنا العزيز داني الذي يشتغل في الكواليس بصمت كالعادة ويقدم حلقات جيدة. نشكر الجميع ونشكركم متتبعينا، وإلى أن نلقاكم في حلقة جديدة إن شاء الله من هنا الأسبوعين. لكم مني ولجميع الأساتذة الذين حضروا معنا هذه الجلسة ولمخرجنا الجديد أحر المتمنيات، والسلام عليكم ورحمة الله تعالى وبركاته.